When countries prepare for conflict, they do not just move troops or secure trade routes. They secure something else. In just 4 years, central banks shifted over 4,000 tons of gold, more than at any time since the Cold War. It was not speculation. It was a reaction to a world where assets can be frozen with a single decision. Why did trust vanish from the system, and what does this mean for the global order? In 1944, delegates from 44 nations gathered in Bretton Woods, New Hampshire, to design a new financial order. They anchored the world's currencies to the US dollar, and they linked the dollar itself to gold at $35 an ounce. Central banks could exchange dollars for gold on demand, a promise that turned the metal into the foundation of global trust. For nearly 3 decades, vaults from London to Tokyo filled with gold bars, and the system seemed unbreakable. But as US spending soared in the 1960s, gold reserves drained away. By 1967, central banks were buying gold at a pace not seen before or since until now. France and West Germany converted billions of dollars for gold, straining the system to its limits. In August 1971, President Nixon suspended convertibility, ending the dollar's direct link to gold and launching the world into the era of fiat money. Gold's official role faded, but its appeal never disappeared. When trust in currencies wavered, whether in the inflation of the 1970s or the crises of recent decades, central banks returned to gold as a backstop. The record purchases of the past 4 years echo that pattern. Each surge has come when confidence in the system faltered, and every time, gold has been the asset central banks reach for first. Inflation raced to levels not seen in decades after 2020, pushing the cost of living sharply higher across continents. In the United States, the Consumer Price Index climbed more than 7% by the end of 2021, and global supply chains buckled under pandemic disruptions. Meanwhile, the US national debt surged past $36 trillion, raising alarms about future stability. For central banks, the old assurances began to look fragile. In February 2022, a single move changed the calculus. The United States and the European Union froze $300 billion in Russian central bank reserves overnight. Assets once considered untouchable, such as United States treasuries, Eurobonds, and deposits, became vulnerable with a single keystroke. Legal tools and payment systems, from executive orders to swift exclusions, showed how quickly reserves could be blocked or made inaccessible. These shocks arrived in quick succession, exposing the limits of financial security in a world where trust and access can vanish. Central banks around the world took notice. The question was no longer theoretical. If dollars and euros could be weaponized, what counted as a truly safe reserve? The answer for many was not another currency or another bond, but something tangible that could not be frozen from afar. The stage was set for a dramatic shift in how nations protect their wealth. Central bank gold buying did not arrive as a single surge. It was a sustained, measured pattern. Year after year, the numbers kept climbing. In 2022, official net purchases reached 1,136 tons, the highest annual total since the late 1960s. That record did not stand for long. In 2023, banks added another 1,037 tons to their reserves. The momentum continued into 2024, with 1,045 tons acquired, marking the 3rd consecutive year above the 1,000-ton mark. Even as 2025 brought some moderation, early data suggested another 800 to 950 tons would be added before the year closed. Over 4 years, these purchases totaled nearly 4,000 tons, double the pre-2020 average, and an unprecedented streak in modern central banking. This was not a fluke or a reaction to a single crisis. The steady pace revealed a coordinated shift in reserve strategy. Each year, official reports confirmed the trend. Gold was moving out of vaults in London, Zurich, and New York, and into the hands of central banks across Asia, Eastern Europe, and the Middle East. The World Gold Council called it the largest four-year net accumulation on record, driven by more than 70 central banks. As the numbers stacked up, so did the implications. The world's monetary authorities were not just buying dips or chasing price moves. They were building a new foundation, 1 ton at a time. The result? Global central bank gold holdings approached an all-time high of 36,700 tons by early 2026, a level not seen in generations. By early 2026, official gold reserves held by central banks worldwide reached an all-time high of 36,700 tons. This is more than a number on a balance sheet. It reflects a deliberate accumulation by dozens of monetary authorities, each responding to their own vulnerabilities and ambitions. China's central bank reported 2,264 tons, though analysts say the true total could be far higher, given opaque reporting and steady inflows through Hong Kong and Shanghai. Poland, once a modest holder, added over 300 tons since 2022, moving from 103 tons to more than 420. That drive was led by the National Bank's target of making gold up to 20% of its reserves, a policy shaped by regional insecurity and a desire for greater financial sovereignty. Russia's official reserves stood at roughly 2,300 tons, much of it repatriated and stored domestically after sanctions made foreign-held assets a liability. India crossed the 840-ton mark, steadily building its position through monthly purchases and repatriations. Turkey's holdings also exceeded 600 tons as the central bank responded to currency volatility and shifting trade patterns. These are not isolated moves. The World Gold Council tracked more than 70 central banks increasing their stocks over the 4-year stretch, with emerging economies accounting for the majority of the growth. The result is a global reserve system that looks less like a single pyramid and more like a network of fortified vaults. Each ton added is both a signal and a shield, a way for nations to assert control over their own financial destinies. The scale and breadth of these purchases point to a new consensus. In an unpredictable world, physical gold remains the ultimate reserve. When a government issues a blocking order, reserves held in foreign accounts can disappear from a central bank's balance sheet with a single legal directive. Executive orders in the United States, asset freeze regulations in Europe, and SWIFT bans all operate through custodians, banks, and clearinghouses that obey the instructions of their home jurisdictions. Once an account is frozen, the owner cannot access or transfer the funds, no matter how urgently they need them. Even attempts to repatriate assets face practical hurdles. Moving gold from a foreign vault to domestic soil requires weeks of coordination, insurance, and secure transport. But once gold is physically in hand, it stands outside the reach of remote freezing. This difference between a digital entry that can be locked and a tangible bar that must be physically seized reshapes how reserve managers think about risk. BRICS expanded to more than 10 members in 2024, adding Saudi Arabia, the United Arab Emirates, Iran, Egypt, and Ethiopia. Together, this bloc now accounts for nearly half of the world's population. Its influence stretches beyond sheer numbers. In June 2024, Saudi Arabia began offering oil contracts in currencies other than the dollar, including the yuan and the euro. For the first time in 5 decades, the world's largest oil exporter no longer required payment in dollars by default. This shift did not dethrone the dollar overnight, but it chipped away at its automatic demand. As more oil and commodities trade outside the dollar, central banks have fewer reasons to hold dollar reserves and greater incentive to seek neutral assets like gold. January 2025 brought another reminder of how quickly the ground can shift. Political transitions in the United States, whether ushering in new leadership or maintaining the status quo, have become global events, watched for any sign of change in direction. For central banks, the lesson is clear. Policy can turn on a dime, and alliances can fracture overnight. Reserve managers no longer assume stability. They prepare for volatility. The rise of a multipolar world means that no single currency or power is guaranteed to hold sway. Gold stands apart as a hedge, immune to political cycles and the unpredictable moves that now define the international order. Today, over 36,000 tons of gold sit in central bank vaults, more than ever recorded. As global power fragments and assets can vanish with a single keystroke, gold's silent migration signals a world bracing for uncertainty. In this new order, trust is measured not in promises, but in possession.